All right, so the S&P finished up a very strong week with a small, very, very small breather today. Very, very good rally. And the question now is, last Friday we talked about this idea of convergence transitioning into consolidation. Have we transitioned, instead of into consolidation, have we now transitioned back into that impulse move without a consolidation? And we're going to talk about that. We're going to talk about how long it's been since we've had one of those 5% declines, which typically coincides with these intermediate pullbacks, and what that tells us about the maturity of this current intermediate trend that we're on, and again, the likelihood that this broke us out into a new impulse move without a consolidation, like we previously had earlier on in the cycle. See, it's not very common to get those, and we might have two of them now. And so we'll talk about that and what that means, and what the different indicators are telling us. Again, the likelihood of this bullishness this week maintaining itself into next week and beyond. We'll also talk about what's the big driver behind this week's move. There is pretty much one big driver, and you'll see it it's pretty obvious when you see it. So we'll talk about that. The sectors and how they performed here. And then, of course, we will take a look at our trade idea, the stock that may be in the beginning stages of its own bullish run to catch up to where the market has been the past few months. Let's go ahead and get started. Today is Friday, July 14th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do. Scroll down to the bottom, click this heart. It opens up this tab, and hit that like button there. Same thing here, click this thumbs up icon. It opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers. So thank you, those who do that day in and day out. Our goal is to get to 100. We're closer. We got closer before. Took a little step back here, but let's try to see if we can hit that over the weekend. Again, those who do that, thank you very much. It's a big deal for us. That's why we always ask. Those who don't, you can do right now with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So small little down day today, only a 1/10%, so nothing too major. It did break up what would have been a 5-day winning streak, our second 5-day winning streak in the past, 13 days. So there was a 5-day winning streak right there. Here was a 6-day winning streak. So we've had some pretty decent winning streaks on the S&P 500. You can actually see them right here. A little bit easier on SPY. You can see it here. There's would have been the 5-day. We ended up with small loss there. There was a 6-day winning streak there, a 5-day winning streak here, all in the past few weeks. So it's been a really good, obviously really good run. It's kept the intermediate line above the 90th percentile, and as I mentioned, it's not very common. We ended up not getting the near-term line to stay yesterday above the 90th percentile, ended up at the 88th. It's not common for both of them to be above the 90th percentile. The blue and the green doesn't stay very long when it does. And the momentum line has already dropped into, not just in the bearish territory, but into, like it did yesterday, but it actually dropped into the oversold reversal zone. So that in and of itself is a bullish intermediate confirmation signal, an oversold momentum line with a strong bullish posture. It's preferred to have the near-term line, if not in bearish territory, at least in the lower half of the chart, and it's obviously neither. It's actually barely below the 80th. So you can see something like this. This was the last time we had that. I mean, very almost the exact same pattern. Intermediate posture strongly bullish, momentum line oversold, but the near-term line wasn't low enough, and so we didn't get the bounce there. In fact, we ended up getting the near-term. We got the oversold. We got the same pattern here, barely at the 19th percentile for the momentum line, but this time the near-term line was in bearish territory, and that ended up being your bullish opportunity there. That led into a really strong week for the S&P. So you would say that unlike what had been the 7th, unlike last Friday, and unlike the intermediate confirmation signal we got last Friday, this is more like the one that would have preceded it last Wednesday, which would suggest that you probably, there might be some more weakness here next week to fill in these gaps, just like it would have done over here. See, we had to fill in this gap from the week prior that the intermediate confirmation signal obviously did not do, and we got a couple more days of weakness to fill in that gap. Well, here's the gaps here, common gaps that are expected to be filled in as soon as next week, not very long from now. Looking at the Dow Jones Industrial Average, which has not been as bullish. Remember, it got a bull tag here recently. Nothing else is even close to a bull tag, but the Dow did, and last Friday, and it did produce a good little bullish bounce, like the last bull tag did for the S&P the S&P as well. It still has not breached a new 52-week high. Whether on a closing basis, looks like we're still off by about 80 points on a closing basis for the Dow, which is not very much considering it's at 34,000. But we're off by 80 points. And then the all-time intraday high point there, we're looking at about 200 more points above where we're at right now. Remember, today we're up 113, so 80 points is not very, and that was a small range. The average range is 300, so to be only 80 points from the highest close is not very much. The market sentiment's been fluctuating there at the low end of bullish territory. Intermediate line has re-entered the upper reversal zone, but the short-term sentiment has not really spent. That's why we're not really going anywhere after the strong start to the week. Now let's take a look at that blow-off move in the NASDAQ. So big, huge move. Also same thing as we talked about with the S&P. This one you did get the near-term line above the 90th percentile. So you had both of them, as well as almost the market sentiment line above the 90th percentile, which is really, really rare to have all three of those lines, but again, it's not common for the intermediate and the near-term line to both be above 90, and it doesn't. The near-term line doesn't stay up there. I think here's a couple of instances here for a few days where it was, and then another instance over here where it was for about a day before you got a near-term pullback, and that's appears to be where we're headed for next week, is a pullback that will bring the near-term line down out of bullish territory. You notice at the start of this run, we were pretty good. We had some pretty decent bullish runs, especially like right here was, this was a pretty decent one, and this was a really long near-term rally, and then followed by a couple of strong ones too. But the last one was kind of shorter, and then this one, if we did finish by next week, would be even shorter than that. So really getting some short near-term rallies, and again, not very similar momentum, intermediate confirmation signal, but not with the near-term line as high as it is, not as high probability. The Russell 2000's near-term line fell a lot more. Again, you do have the intermediate confirmation signal on there. We actually almost got it yesterday. We ended up at the 21st percentile. We did finally drop to just below the 19th here. Intermediate posture still strongly bullish. In this case, your near-term line still in bullish territory. It's not quite in the upper reversal zone anymore. So again, you would expect that we would more than likely going to get a little bit more near-term weakness to continue filling in this week's gaps on the Russell 2000 as well. Let's take a look at the weekly charts, but let's start off with the weekly market forecast first, since it's Friday. And you see the near-term line is not in the upper reversal zone. It's in bullish territory. Your momentum line is flirting with getting in bullish territory. You see the short-term sentiment is not nearly as strong as it has been. We've been up and down literally every other week, showing bullishness and bearishness. On the S&P, you see the NASDAQ, the same thing, right? After getting this cluster, we've continued higher, again, without the near-term line being in strong levels and momentum line at the low end. Your Russell 2000, you can see kind of breaking out here this week, even with this drop today, a little bit of a breakout move. We still haven't quite broken out above this February peak or this August peak from last year like the rest of the indexes have. So your intermediate line still trying to get into bullish territory, and your near-term line is not really helping, as it's not in the upper reversal zone either. But it was a good week nonetheless for the Russell. Let's take a look at these other charts. So on the S&P 500, you can see we did get a higher high and a higher close. Another long upper shadow. We're starting to get a lot of long upper shadows here. The size of the candle ended up finishing slightly above its 3-week average in this case. Still very small candles compared to where we've been below. The average is kind of falling, and so something to keep an eye on in terms of are we going to get a higher high next week, or are we going to get a higher close? Right, those are the early indications of transition in these indexes. Of course, the Nasdaq's nowhere near. The Nasdaq, you can see it is getting another long upper shadow, and we are now 10% between. I mean, that's the high level, the highest level it's been since way over here in the early part of 2021. When we started, we had a couple little declines there. So very strong move, even though we're not at all-time highs. The PPO is, and we're also not with very strong, very large bodies on the Hakinyashi candle either. And we've gone quite a bit. In fact, if you look at how far we've gone without like a 5% drop, on the S&P 500 we're up 17%, and that's a pretty decent number. Last August we went up 17% going into the last Jackson Hole event, and then we ended up with a 9% decline without a 5% level there. Of course, in 2021, coming off of the reopen trade and the inflation trade, we were up 38% on the S&P without a 5% decline, 30% coming off of the COVID low here without a 5% decline, 19% going into COVID. So 17% is a pretty decent number. It's not extreme. The Nasdaq, on the other hand, it's pretty strong. I mean, that's one of the biggest numbers we've seen in a while. Again, coming off that COVID low where we initially surged, dropped 5.2%, and then we rallied 31% going into COVID. We're at 31% now. So we've gone 31% from close to close on the NASDAQ 100 without a 5% decline. And then last August, you can see that was the biggest number of the cycle, 22, almost 23% without a 5% decline. So needless to say, the NASDAQ has made quite the run, and with that long upper shadow that we're seeing now and the smaller bodies that we've been seeing, it is, we need to pay attention to transition signs, right, of when we might start to get those. The Dow Jones Industrial Average has been forming transition candles for the past 4 weeks, very small bodies, upper and lower shadows. We still haven't cleared, after getting the lower close, we still haven't cleared that body yet to really get the reversal to take away the potential for the downside, to just continue to the upside. So the Dow is in danger of a reversal. And then you can see we were in that same boat with the Russell the prior 3 weeks, exact same as the Dow, but we did close above that body this week on the Russell. But we did end up with, again, another long upper shadow, and the body was not very big at all. So we'll see. We didn't close at that high point, the high point here being at 1952, so we're kind of here at 1931, and then there's where the body's open is going to be. So we're going to have a pretty decent sized body next week. The question is whether we're going to get a new high next week. Even if we don't get a transition candle with a small body and a lower close and upper and lower shadow, we could get a lower high point, which you can see here typically can transition you into the transition and ultimately the reversal. All right, if you look at the 3 green arrows, so we have 3 green arrows still on every single index. It's 2 days now for these. Remember, it's, we've had 2 days before. We kind of need to not get 2 or just 3 days. We need to keep this up, and considering, again, the gaps that are expected to fill over this next week, it's unlikely that we'll probably stay up here. The MACD is pretty tenuous, as you'll see here on this chart. If you look at when we break these lines up, the MACD is not very far above its moving average. In fact, it's, like we saw the week before, when we got the same signal right there, the same bullish intermediate confirmation signal on July the 5th. We got that now. 2 days later, 1 day later, that we were right back below The MACD was right back below its average, and which is a red arrow. So we can't have that. We cannot have one or two red arrows already on Monday or Tuesday. Again, would be a sign that that's of convergence. Convergence means that we're still bullish, but we're just running out of gas and we're headed towards consolidation. Convergence on this is long periods of no 3 green arrows and then short periods of 3 green, which is the opposite when you're in a strong bullish move where you get long periods of 3 green and only short periods of a red arrow, of 1 or 2 red arrows. So over here, the diamond's actually got 3 red arrows on one of these days. So we'll see if the Russell's a lot more bullish, but you can already see its histogram has rolled over. Let's keep our eyes on just how, if we can go all week long next week with 3 green arrows, that would really go a long way of postponing any consolidation that we can get for a little bit longer. All right, going back to this chart, well above 8 days, 17, 30, all of these indexes way up above like the 50-day moving average. So for an example, if I were to show you here, this would be the 8-day, and let's use the 50-day simple for the second number. This will kind of give you an idea of the gap between the 8-day and the 50 here. And let me zoom out so you can see some context on just how bullish we are right now. So right about at 3%, the 8-day exponential moving average is 3% above the 50-day moving average. It doesn't look like it's very much, but you can see as you follow my cursor to the left, that's a pretty decent level, even during bullish trends, as well as during the bearish trends. In fact, the last time we had a green dot, which is the 90th percentile of this 5-year time frame, was last August, going into the Jackson Hole event, where the markets got a little smackdown from Powell about not understanding the narrative that he was trying to pitch. And we wonder if we might get something similar here this go around, as the market's a lot more bullish. You notice though the stochastics, however, unlike all these other times that we were at these levels or slightly higher, the stochastics is lower than any of those other times at its current pace. So kind of an interesting development here, simply because we've already had our peak, right? This is our peak momentum was going into June. Now we're kind of forming these divergent high points as we are, barely, like we're not going to get a MACD higher than this level, more than likely. If I were even just to swing back out now to just the regular MACD 817 that we use to coincide with the 30-day moving average. Again, we're not going to get a peak on the MACD higher than this on this particular cycle, not 3 months plus into this current intermediate trend, which means we're going to get, we're in convergence mode still, and it's, we're back on impulse move, we're back in the direction of the trend with some momentum here, but it's slight and it won't last more than likely won't last very long. Your DMI is above 40, it doesn't stay above 40 for very long, especially with the negative indicator already forming higher lows and the ADX already so high. So you wouldn't expect the DMI to stay up here so long. The RSI is above 70. That's not, yesterday it hit above 70. Today, because of the slight decline, it dropped a little bit below 70. You already have the divergent high point forming on the CCI. That's an extreme level. The RSI, you notice, has been in bullish territory now for quite a while. We haven't dipped below the 40th percentile here for some time, and we finally did. When you break the midpoint, that eventually leads to a decline in below 40. That's kind of when your bearish territory starts, and we've had a few breaks of the midpoint, but we haven't even done that since, when was that, the middle of May or towards the end of May. So it's been a while since we've even been below 50 on the RSI, and as well as it's been a while since we even hit below minus 100, which is kind of a similar has a similar impact as breaking below 50 on the RSI. In fact, you can see these 2 times were the 2 times here, as well as this one. So we've been bullish for an extended period of time, and maintain these kind of extremes on the index itself. You can see this trend quality getting up to over 7 now. Again, the highest it got to last August was 6.25. We haven't been over 7. Let's see here. This is the 5 that I'm going to keep on there, but let's just put on where we're at right now, which is 7 over 7. Well, let's just put it on over 7 for now. So, and we'll put it at 1, and let's put it like in a black line. All right, if I were to zoom out on this for some context of just how strong the trend is, this black line right here, you can see we got up to 7, so similar levels back in November 2021, and the last time we were above it was in 2021 and September, before we had that correction, or the intermediate pullback that ultimately led to these divergent highs and the ultimate correction here. Before that, you can see in 2021, early 2021, we had a couple peaks that did not get this strong. And then, of course, in 2020, we had a couple parabolic peaks that got up to these levels. And here we are again, forming similar parabolic peak with the noise balance here well above 80, up to its highest level that it's been in quite some time as well. So looking at the Bollinger Bands and the Keltner channels, we have now closed outside of the bands for pretty much, if you count today at 99.49, we're pretty much there. We closed this, because of the slight decline, we closed a half a percentile below the 100th. So I mean, it's pretty much 3 days above the upper band and above the upper Keltner channel, with the bands itself outside the Keltner channels with new green dots. See, it's not very common to get, these kind of, you get them kind of early here, where you get the red dots as we dip back in, but that was really early. This obviously is really late in the intermediate cycle. So again, another kind of sign of how extreme the move has been. And when you look at the bandwidth as low as it is, if I zoom out, as low as it is here, you're pretty much at what was the 150-day lows until this sideways action. That's not a very large bandwidth. It's one thing when you're peaking at a very high bandwidth, like we did in last August. This would be we've already had the peak in the bandwidth, so we've already had the momentum here. Again, going into that June expiration, and this is more of a divergent high point, and that seems to be forming. You can see the gaps on the intraday chart here, very easy to see. These two gaps are the important ones. Common gaps, you expect they will get filled. We're well above the value area. There's not a lot of support here, so it's very easy to fall back down into this spot because there's not a lot of volume support. That doesn't necessarily mean we're bearish. Remember, it's been a long time since we've had a 5% decline. To get a 5% decline, if this ultimately is the peak, and who knows if it actually is the peak, but just for some context, if this is the peak, a 5% declines all the way down to 42.79, so it'd be down in this area. So that kind of gives you some context. Because we will. You never do go without a 5% decline. So we will get one at one point. Remember, the NASDAQ is even worse, right? It's gone up 31% without a 5% decline, which is a very large number, even in historical context. Really, 2017 was the only time that you went 50% higher without a 5% decline in the midst of a very, very low volatility period. So you're going to get a 5% decline, and you're going to get the beginning stages of that, even just dropping down to 442.86, filling in the rest of that gap here from the peak at 451.36 would be nearly a 2% decline. And we haven't seen, like I showed you before, we had a 5% winning streak. We haven't had a 1% decline since May 23rd, and that was 1.12. And we haven't had a 2% decline, which is what starts these intermediate pullbacks, since February 21st, right? And if you look at where the market was on February 21st, way back over here, right there, that was the day that started the last intermediate decline. That was the last time we had a 2% decline. And those are generally the types of days that start intermediate, those 2% declines. And whether if we fill those gaps in one day, then we'll get that. That's the kind of move it would take. So you can kind of see what kind of bearish day it would take to actually start to get a bull tag, and that which these weren't. Like if you look at May 4th and May 24th, which was our last two attempts at a bull tag, May 4th was right here. Was right here. Obviously not anywhere close to 2% decline. Then May 24th was right here. Again, not anywhere close, not even a 1% decline, much less a 2. So those bull tags are a lot different than the last one that started an intermediate decline, and that's the kind that we would need to see to start, because you will. I mean, those 5% pullbacks are these intermediate declines. The 10% drops are your corrections, right? So these are just 5% pullbacks. I think both of these were like in the 7% range. So that's forthcoming at some point in time. You look at the, and I believe sooner rather than later, because I think these gaps are kind of telling, and we've had our peak in momentum, and now we're just transitioning from impulse move to convergence to eventual consolidation, which is what leads to that. And that's why I think we're headed towards, again, like I said, sooner rather than later. If you take a look at the volatility index, and again, I've been mentioning before, we've been setting up for a move higher in volatility as we approach what is a seasonal low for volatility over the last 20 years. The VIX typically bottoms out at the end of this month, right around July 25th, and then it rallies all the way to the end of October. So August, the full month of August, most of September, a little bit of a decline September, and a little bit of a decline October, but most of October, from now until the beginning of November, where we peak on this end of year to date, then that's a typically bullish, and we're a lot lower now than we typically are. We're on average about 10% down in the VIX. We're 41% down in the VIX. We're down on the absolute basis. You can see the correlation's gone back to negative levels. It was slightly positive. And of course, as you saw here on this chart, let's see right here, you saw over the past week, the VIX has been down a lot, and the VVIX has not been down at all. And the VIX relative to the VIX 3M is down below 85%, not as extreme as it was a couple weeks ago, but still we're at similar levels on an absolute basis. In fact, when you look at it compared to its own average values of different time frames, you see the VIX is still extremely low. But you notice that the momentum's not there for the decline like it was at the beginning of June. The momentum has really decreased, as you can see here on this chart. But if you look at, again, how far away we are from like its 200-day average value on a simple basis, you see we're 30% below, which is still an extreme. Not just in the past year, but in the past 20 years, you're in the second percentile of where it generally is. That puts it in context of this big spike right there. But that's where we're at right now. That's how extremely low it is below its 200-day moving average, as well as, again, how uncorrelated it's been with the VVIX and how low it is relative to the VIX 3M. And not only that, remember too, I always bring this up, how compressed it is. When you look at its average, its normalized range being below 10% without a spike. It's very similar to what we saw here. I mean, this makes it look like it's normal to be below 10%. If you remember, though, it's not normal to be below 10%. It generally is only normal when you get the spikes, and when you are below it without the spikes, it generally leads to a spike. And as we've seen, that you can see the spikes. You can see this initial spike is what caused it to get below 10%, and some of these others spikes cause it, and those ultimately led to the jump higher. This was a huge spike that got us below 10%. This was a big spike that got us below the 10%. And so then we spent all of the end of last year compressing. In the beginning of 2023, we had the regional financial issues, and you had a small spike there that brought the normalized ATR up to about 15%, and now we're back down below 10% without a spike to cause that. We were below 10% before this little jump, and we're still below. So again, that just means that the ranges of volatility are very compressed with each other right now. So when you look at it, for example, on this chart, pull up the VIX here, and we look at how the ranges have been gradually moving, let's say on a weekly basis. Look how much it's gone down on an absolute value. The numbers are just getting gradually smaller and smaller and smaller, even on this basis here, on the normalized basis. You look at it on a monthly basis, and you'll notice again, we're really compressing. The ranges are getting gradually smaller and smaller and smaller, which makes sense because the absolute value is getting smaller. That makes sense that the ranges would, but that's what happens, right? That's what happens in this case, and it leads to an eventual decompression where it really expands out pretty hard up to the upside. All right, now let's talk about what's driving this price action. Again, you can see the Qs, and especially on a year-to-date basis, just killing everything, right? But you can notice, too, that the dollar's been the biggest driver, really, since yields peaked on July the 5th. From July the 6th going forward, the dollar's really declined pretty sharply. It's stabilized today, but really declined sharply from that July 5th period. Again, when the 2-year yield peaked about 5% and the 10-year peaked about 4%. They since have dropped every day, almost every day since then. The dollar has dropped pretty much every day since then. And that has pushed everything higher. Look at commodities higher. International stocks are doing only IWM is outperforming international stocks, and really not even that much. It was, and today it pulled back down below EFA and EEM. The Qs you can see are up there. Gold is rallying. Real estate, high yield is outpacing treasuries. I mean, but treasuries are up. Everything is up, and this is long-term treasuries, right? Right, not the 10-year yield. This is the 20 to 30-year yield. But everything is higher because of, I mean, that 3% drop in the dollar, that is a significant move. And I showed you before in the last market outlook. That's a significant move in this very short amount of time. This is what it looks like against its peers. So when you look at how these currencies have been performing over the past few, since that same July 6th time frame, here's how the currencies are performing. These Swedish krona, Norwegian krona are both up 6% or more. But look at the franc and the yen outpacing almost everybody except for those two. The pound, the euro, the Aussie and the Kiwi, the Canadian dollar, Mexican peso. Again, they're mostly tied to the U.S. dollar through trade, right? Those two. So everything, but the franc and the yen, which have been doing very well, are safety trades in the currency world. And the fact that they're outpacing the pound and the euro is not necessarily the best sign for risk appetite from a currency standpoint. If we look at the 12 grid for currencies, look at the major ones, all the main currency pairs, you can see the euro and the pound, strong 3-month moves, dark green shading, green line. Same thing with the Aussie and the Kiwi. Here's the U.S. dollar as the base currency against the franc, yen, and Canadian dollar, both down sharply. There's your euro versus the pound, not doing very well. The euro versus the yen has down. Has pulled back, as well as the pound yen, the Aussie yen, and you can see the euro Australian. I mean, this is a dollar-driven move. This is the biggest mover right now since the where is it? Here we go. So pretty much since the right here, there's it's July 5th. We hit about 5%. It was like that was the time, and that's when the rate hike odds for that second rate hike peaked, and the rate cut odds bottomed out for, you can see by the end of the year here, you can see there's your peak right there. July 6th on the day after was the highest level that we had, about 43%, that we would get a second hike by the end of the year and stay there by the end of the year. Of course, that has dropped down precipitously there, but the rate cut odds are still very low, are still relatively low. They were at their lowest then. Here's the about a month ago. You can see the rate cut odds were at 48%. They dropped down to 10 a week ago, and they had jumped up to 25 yesterday. They dropped back down today as a 2-year jumped back up 15 basis points today. The 10-year yield up 7 basis points. All of that with a U.S. dollar that just hardly budged. I mean, again, so oversold. and it bounced up a little bit today, but not very much. And this is an extreme move on the dollar. This is the main driver of what's going on here. You can see just extreme levels across the board, clusters, multiple clusters on the market forecast chart. The RSI hitting up to very low levels, the lowest levels in the past year. CCI also dipping down to minus 200 along with that. I mean, lots of just extremes on the dollar index, dropping way below. Like this, it's one thing to get below a little bit here as you start a bearish trend. It's another thing to get this far below. This is way below, well below the Keltner channels as well. I mean, that's an extreme level. Again, we didn't get that far below the Keltner channels before ramping back up, and I expect that that would be the case again. That this is, and there's your July 5th peak, and that's what the dollar's done. 1, 2, 3, 4, 5, 6 in 6 days. And I showed this briefly on Wednesday, but in 6 days here, sorry, let's go 6 days here and here, and then let's pull up the dollar index. There's the drop and how deep it was. Again, you can see some other examples of that back here in October, where we dropped from a much higher level than we were now, and a stronger bullish trend than we are now. And then here in November, where we dropped in 6 days over almost 6%, and that kind of broke us out of a bullish trend to the downside. We're not breaking out of a bullish trend right now on the dollar index and heading to the downside like we were here, where we were green shading, and we just started our dark pink shading in a red line. We have been sideways here, and this is an extreme level of multiple clusters that you wouldn't expect would continue. We're a lot lower now, for some context in terms of how low we are. Over here, we were just breaking the 23% retracement of this big long run. Now we're sitting on the 62% retracement support level of that big long run. So a much different story now than then, and a story that you would expect would lead us to a more of a bounce back up off of these extreme lows, bounce back up towards where we were. And again, that was a driver. It wasn't the driver for the initial surge on the up to that June 15th, the June expiration parabolic peak in the markets, but it has been the impetus for this past week's surge that's been correlated or coordinated with these really soft inflation reports that we got on Wednesday and Thursday especially. All right, if you take a look at the sectors, you can see, not surprising, I mean, look, dark green shading and green line all across the board for every single one of these sector moves, all the way across the board here. And then when you look at the comparison chart for this past week, right, this has been a very strong week, led by the weakness in that dollar. So if I were just to go here to, let's go to calendar. So at the beginning of this week, you can see there's been different. I mean, energy and industrial started the week strong, along with financials and real estate. Energy has since pulled way back. Staples has been lagging behind this entire time. Utilities has been up there too. Real estate has been matching. But by the end of the week, technology, which has been an underperformer, has been one of your best gainers. Communication services, which also started off the week, but then became very strong by Thursday and then held most of its gains. And then the consumer discretionary really caught up today. So those are your three areas that have been leading the markets, and those are the three areas that you would expect would lead the markets because of their market cap. Yes, that market cap weighting is changing on the NASDAQ 100, but it's not on the S&P 500. So it's still maintaining a strong bullishness there. If we take a look at the relative rotation graph, you can see here, let's go to the sector rotations, the market cap weighted. There's your XLK, XLY, XLC. Let's go to the daily chart. They continue to have a very strong relative strength. XLK is moving up. Here, let's go over the last 2 weeks so we can see the trend. Fit this in here. So there's XLK, which had some weak momentum, but it's really gaining momentum and maintaining some relative strength. XLY has had weak momentum too, but still has strong relative strength. And then XLC, look at that moving up to the right there. Energy and financials and real estate have been doing that. Staples, healthcare moving down to the left. Utilities also has the weakest. So not surprising to see the safety trades. But again, going back to that weekly chart, kind of a more longer term basis. XLK, XLY, XLC have the strongest strength. XLK, XLY have momentum. Financials and industrials are the biggest momentum gainers, where staples, healthcare have been momentum losers here, moving down to the left over the long-term chart. And then finally going very long-term, you can see the cyclical areas of the market moving down to the left. XLK, XLC, XLY are actually moving up to the right. They had really underperformed during the correction, and they have since been now regaining some traction here. While energy, which had been the biggest winner over 2022, have been the biggest winner here. And you can see utilities and staples and healthcare moving there in the other direction. Now they're moving down to the left, along with energy, and your cyclical areas moving up higher. How much higher they end up moving up remains to be seen. If you look at the equal weighted versions of these sectors, again over the long term, you can see that the financials, again this is on the weekly, let's go back to the monthly chart here. Here is your stocks that have the biggest momentum moves. You have communication services there, you have consumer discretionary, and you have technology. Even their non-weighted areas are moving up, and of course industrials is up there too, as well as healthcare, interestingly enough. And then you have staples, energy, and utilities moving down, along with real estate, financials, and materials also moving down to the left. So there's a clear shift, but the problem with that shift is, you have, again, the Qs at such extremely bullish levels that have been converging for so long here, and you can see it here on the daily chart. It's been so extremely bullish. In this convergence mode, the RSI is moving down, the MACD is moving down, the CCI has been moving down, the DMI has been moving down, with the negative indicator moving up. So you have this convergence mode with a very strong momentum that is due, and again, considering the strong correlation with the markets of this ratio, a break into this gap between the 50 and the 200 and filling in that gap. It's just a matter of time of when that will happen. We had a reprieve this week. We tested it at the beginning of the week. We had a reprieve in the last 3 days. The ratio really jumped back up, and it got almost up to 2 at the highs of the day today before pulling back. But you are back above these moving averages after failing at that 200, but you still are in convergence mode. So we still haven't gone back up to where we have, an impulse move back up to the upside yet. So it's just a kind of just a waiting out the weak hands while it's setting up this convergence for the ultimate shift into consolidation. And this week just delayed a lot of that with some knee-jerk reactions to some headlines that won't be the same headlines at the next CPI release. And then, of course, the Jackson Hole event that will come after that wasn't so bullish for the markets, and the markets are even more out of tune with what the Fed's narrative has been now than it was even then in that particular August. All right, now let's take a look at our trade idea. I want to take a look at AbbVie. As you can take a look here, you can see AbbVie's kind of had a similar pattern as had the last couple of times that it started this intermediate runs. A couple of bear tags back to back. The first bear tag, while the intermediate line was still pretty heavily oversold, like this first one was. But the second bear tag with the intermediate line either almost out of bearish territory or all the way easily out of bearish territory. In this case, above the just barely below the 50th percentile, and that's kind of how we are right now. So this is the bear tag that you expect after a strong bearish decline in the big convergence period, that you would lead to a new reversal pattern up to the upside, barely finishing above the 30-day moving average here today. If you take a look at the weekly chart for the stock, you'll see that we've got a couple of transition candles, as bearish as we've been, but you notice the biggest bearish candle was over here, and we've been converging ever since with very, very weak bearish candles, again setting ourselves up for a reversal up to the upside. You can take a look at like the Hull moving average, for example. And we actually do have a green Hull moving average after reversing really quickly yesterday's move, as we're getting closer to that 200-day moving average, and the candles are getting bullish, and the parabolic SARs are down below. So it's a nice, good move higher. If you take a look at where we are on the moving averages, again, you can see the convergence here. The MACD's been rising this whole time. We closed above the 30-day barely, and the 17 at the same. In fact, the 8, 17, and 30 all at the same time. Still got some gap to fill in between to the 50, and then a much bigger gap between the 50 and the 200 as a possibility for this to fill in. Some of the oscillators are starting to show some very weak bullish strength, but again, a reversal from what the strong bearish moves that it had there on the DMI, and then looking at like the RSI and the CCI moving out of bearish levels up towards the beginning stages of bullish levels, and you can see that as well in the Bollinger Bands and the Keltner channels. You see that again, the bands have been inside the Keltner channels, and we had been in the lowest quadrant quartile of the bandwidth, outside of the bandwidth even, but now back into the upper half, barely, but back into the upper half, back above the lower edge of the value area there, and again, the possibility of things starting to turn around for that. So a little speculative move, similar to the last trade that we did. In this case, we'll sell at that 20 delta like we did before, buy at the buy here at, in this case, the mid 30s delta. So instead of giving us that 4 or 5 to 1 reward to risk ratio, that's very low probability but a high reward and very low risk. Remember, probability and risk are associated with each other. So if you want to do a lower probability trade, there's also going to be a very low risk trade. Whereas the higher probability trades have more risk. In this case, I still have a pretty decent 3 to 1 reward to risk ratio for that, and that's with the max gain easily inside of a 1 standard deviation move is all it would take to get to that. So that's kind of the idea behind the trade, and setting ourselves up for what may be a reversal in this stock to catch up to where the rest of the market has been over the past few months. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free as well. Follow and like us on Twitter and Facebook. Have a great rest of your weekend, everybody, and we'll see you all on Monday.